We are a country that is broke, insolvent, and how do you pay back that debt? What do? You just, my mentor, Richard Russell, always used to say that, and this was 15 years ago, that the Fed is screwed and they have two choices: inflate or die, inflate or default, print or die. What about option number 3, find a villain? You incentivize these folks by weaponizing the dollar, telling Saudi Arabia and the rest of the OPEC countries, hey, we're going green, we don't need you anymore. And then you create massive divisiveness in this country. You create a situation where what it means to be an American, what inspired people, even probably like yourself when you were young, to dream of being an American is no longer maybe the vision or the thought that it once was. And you inspire this type of union that is being born. And if indeed they did make the switch where, hey, you know what, we don't like the prospects of a currency that is indebted as you are, with really no prospect of ever paying that back other than inflation and inflating away the currency, and you blur the metrics by which inflation is gauged, we're going to go a different direction. And if that indeed happens and the dollar gets globally dumped because they're no longer needed to be held or stockpiled, and they're losing value as some players start dumping, and then others, and then others, and then others, and all of a sudden the dollar starts to really get crippled and lose value, and they hit our shores, creating a massive increase in the amount of dollars that hit our shores because there's way more outside the country than in, as the stockpiling dollars to buy oil has necessitated that. The byproduct of that is spiked interest rates to the moon to compensate for that inflation, which then blows up not only stocks, bonds, and real estate and the dollar, but the banking system as well.
Everything goes down: stocks, real estate, commodities. Commodities have gone down the most first. Gold is holding up because it's seen as a safe haven until things failed. Same thing happened in 2008. But stocks are the lead now, and that's why I'm focusing on the NASDAQ, the more racy of the stock index. I'm predicting gold goes down to 900 to 1,000. That will be a lot less than commodities again, but that's still a 45% fall from here. So anybody thinks gold's going to protect you here, good luck. My projections, and again, going back to the same place, the 2009 lows, that the S&P be down 86%, NASDAQ 92%, and the Russell 2000 about 92%. Well, the simple thing going on here, central bankers are determined to never have a recession again. They see recessions as a bad thing, which tells me, as somebody who's been involved with the highest levels of Fortune 100 company strategies and many, many new ventures and small businesses on the innovative end, failure is the secret to the free market capitalism. That yes, you have to have the freedom to innovate, new companies to grow, and not be over controlled and all this sort of stuff. But you also have to let failures get cleared out. Okay, and that's what they're not doing. When 2008 hit, and by the way, Michelle, I predicted that decades before it happened. Late 2007 was due to be the peak of the entire baby boom, massive spending wave as they got older into their peak spending from 1982 to 2007. And when that hit in 2008 and early 2009, and they saw how bad the economy got, they just panicked and started printing money, and they thought, oh my gosh, $1 trillion ought to get this economy back jolting and going. Well, it didn't. And now they've printed $8 trillion many, many years later, 14, 15 years of stimulus. I actually count $27.2 trillion, 9 trillion money printing, 18 trillion, basically deficits by the government. I mean, and you don't usually run deficits every year, especially in boom time. So they have fought a downturn with stimulus that nobody would have dreamed of. I admit, no, I didn't see 27 trillion in stimulus to stop this train. And on the other hand, anybody with the least bit of common sense would say, if you keep taking the easy way out and just printing money and just having the government spend more than they take in and worrying about the rising debts, and now we have the highest debt ratios, public and private, and the private is 3 times the public. I'm not even worried about the government and them defaulting. I'm worried about the private debt, which is 3 times the government debt. So this is something that has to come back into balance at some point. I and anybody else has died a million times trying to predict this because they are, here's the thing. Once you start playing this game and keep stimulating. I mean, here's my thing. Here's where I'd give the Fed the greatest criticism. They had a chance in COVID to let the economy take a break for a good reason. Nobody would say there's something wrong with the Fed or the economy if we have a minor recession or something because of COVID, because people can't go out and spend money and can't congregate and socialize and all these things. But no, they doubled down. And $10 trillion of deficits in 2.5 years, $10 trillion, the biggest stimulus ever. And that's why we're still going. That if you have stimulus like this, you have to lag it forward a year to year and a half. So this stimulus is just starting to peak and wear off. And now, because they went so far in loosening, they finally did. And this was the mistake, going so far with overreacting with stimulus to COVID that they created 9% inflation literally overnight, okay? And then they had to go and tighten 525 basis points, and they may still have to throw in another quarter. That's the biggest tightening since the early 80s, which led to the biggest recession back then since the Great Depression. And I think you have to say, you can't say this hasn't hit. It's going to take to the end of next year before we see, end of this year, 2024, before we see how much it hits. But yes, am I humbled? Yes. I mean, have they been able to keep this ridiculous overstimulated economy going? But is that good? Is it good if somebody keep taking crack to get high or the answer they say, what's the problem when you have a hangover drinking? Drink more. That's what we've been doing, basically. And I call that bad policy, and there will be consequences. And if there is not in the next year and a half, I'm probably just going to quit my profession. I don't have to have my newsletter and stuff, frankly. So I'm just going to quit because this is going on so long. If they really can keep a boom going this long with no consequences, then it's really true. Why are we working? Why are we investing, taking risks when all they have to do is print money and we keep going? So if that's the truth, then okay, fine. Really, people shouldn't be listening to me. It hasn't hit yet. A year to year and a half before you know how much that stimulus is going to hit. So we won't know until the second half of this year whether we're going to be able to get through this and that the tightening was not too much, okay? We won't know that till then. And the problem is by then, things could be happening very fast. And when you bubble, people have to get, bubbles don't have there's no soft landings really in history, okay, of any consequence. Bubbles particularly only crash because they go to such extremes by nature when people are just investing in things because they're going up and they keep doing more and more. When it crashes, it's hard to stop those crashes once they get enough momentum. So what I'm really looking for, Michelle, and I really will kind of shut up and back off if we don't see this year, I am looking for a next wave down in stocks to gain some momentum, and it gains enough momentum once we hit a new low. And the magic number is 10,088 in the NASDAQ. If we break down through that, then we're in another big wave down. And I think that wave's going to have more momentum than the first. You go a lot lower. And then we see what investors think. Then we see if people don't start panicking, slow down on their spending and house buying and get scared of owning stocks. I mean, because right now, you have to admit, the Fed, what the belief is right now, the Fed will not let the economy or the stock market go down very much for very long, so there's no big risk. Well, first of all, that's bad. That means people have no discrimination if they think you can just throw money in the economy. And by the way, that's what the central banks are doing. They're just throwing money into the economy with no discrimination, just throwing it in, printing it, throwing it in by buying their own treasury bonds, okay? Which they're issuing at record rate, but they can push interest and pushing interest rates down to well below what the market rates would be and think there's no consequences. So we'll see. But at this point, given how far they went on the stimulus side, which I wouldn't have thought they'd have gone that far, okay? But once they do, we don't know how the tightening,
right
now that they've gone the other way, 525 basis points, that is the biggest tightening only rivaled by 1980-81 in history. In history, if that doesn't affect by the end of this year when it should fully hit, then I'd say, yeah, well, they've created a magic wand here. What am I doing poo-pooing this wonderful innovation? We did see a steep crash, 38% in the NASDAQ, 28% in the S&P in 2022. That is totally consistent with the first wave major crashes like 29 to 32 throughout history. So only then did I say, oh, now it finally looks like the crash has started after they pushed it back. But now, if it doesn't follow through really pretty soon, then all that needs to happen is to continue to play out the past massive $10 trillion in 2-year stimulus. You know how big that is, Michelle? That has not even remotely ever happened any time in history as a percentage of the economy, just to keep this crashing train going, okay? That is going to hit increasingly into mid to late this year. That's what we see. The old stimulus has to wear off. That's peaking already, and that's going to start to go down. And the new tightening is going to hit at the same time, all in 2024. So unless you apply these lags, you can't make sense out of this. And so these lags will be able to fully work out the fading of the old stimulus, which was massive, and the full impact of the new tightening, which was also massive. Both of those will hit by the end of this year, and then we'll know. Until then, I don't care what I've said in the past. I don't care what anybody said. What I see, I would not have my money sitting in large cap stocks right now, hoping for the best. I'd rather be out for a year. They've been stretched so far. How much higher can they go? I'd rather forego those gains and not get hit by a crash. The next crash could be down. We could be down 60%, by the summer. 14 years of nonstop gains purely on artificial stimulus, no demographic support, no other things, fundamentals. What do you think the risk is at this point when they keep propping up and bubble, and somebody keeps getting drunk night after night? What's the risk that they're going to fall down on the pavement and break their skull? It's going up. Be my guest. I'm not taking it, period. The audience can do what they want. If you want to go long this market, you want to sit in stocks, be my guest. Anybody in this audience, be my guest. I'm telling you, I and anybody intelligent I know is not doing it, because you can't keep going a bubble forever. There are people addicted to heroin that they can get massive toxicity until they finally fall over and hit the pavement and end up in the emergency ward, okay? There's people that can go longer. This economy's gone longer than it should have. The stimulus has been heroic, but they did tighten. So now that they finally were forced to tighten, and again, they didn't have to over-respond to COVID. So that was a big mistake. Even if you're gonna be a stimulus policy and you're going to say, we're not going to have a recession no matter what, so we're going to accommodate the economy, to overreact to COVID that much was a big mistake. And so until this whole thing plays out, again, old stimulus wears off, which is happening now, I'd say right about now, into the end of this year, and the new stimulus finally that they've already put in back in July will hit by the end of this year. The end of this year is when we can judge. I'd rather be on the sidelines judging this, because if we do have a crash, the market's going to go down way. I'll promise you this. If we do have a continued boom this year versus a crash, the crash will happen way faster and harder than the boom, because the boom's already so stretched. The crash has been prevented heroically by central banks, which to me is bad business. If you say you believe in free market capitalism, that means you let the capitalists in the markets make the decisions, and you don't force it to grow. Force the economy to grow for 14 years. The economy suddenly starts to slow for no obvious reasons. Consumers have spent and keep borrowing and keep getting a new loan to improve their house, all that stuff, until there's nothing to improve, and their kids have left, and they don't even need the damn house they have, okay? That's a lot of people are in that mode, okay? So spending, the economy has to weaken and respond to this tightening. And I'm expecting, the only difference, anybody would expect this tightening to have some effect. I'm saying since they put off this tightening so long, and then when they finally tighten, they tighten hard, they're thinking the economy can take it and it won't be a big deal. I think the economy can't take it. That's the difference. And if it does take it and there's no big deal by the end of this year, then I'm probably going to be out of the forecasting business. Here's what I don't get. If you want to help the everyday person stimulate the economy, why are you pouring the money into financial markets? Who owns the top 10% own 88% of the financial assets in the country, okay? You should be sending checks to people to spend on everyday things. If I do want to stimulate the economy and prevent it from cleansing. I still think the economy needs to take a big crap and a big nap, okay? That's my view.
Well, okay, I don't know that you want to be sending stimulus to people. That's what we did it. That's what we did in COVID. That's what we did.
People and not the everyday person.
Right, but that's
financial markets collapse like they have in times after, and only after bubbles. Every bubble in history has burst, period, 100%, no exceptions, especially of this magnitude. These things burst the fastest and caused the greatest, but the Great Depression, was not that big. It was 25% unemployment and an 89% stock crash simply from a stock bubble peaking and bursting. There wasn't even that big a real estate bubble because people couldn't get real estate loans like they can today. Real estate didn't bubble up like stock. Just a stock crash caused 89% unemployment when it finally hit, okay? And a decade of depression off and on. There is consequences to this. And again, if there isn't in the next year or two, I'll just quit and say, I don't know anything about anything. I've studied history, and if anybody studied more than me, I will kiss their you-know-what and cuff it, okay? First wave took us down 38% in the NASDAQ, 28% in the S&P 500, okay? Now we've had this bounce back to new highs in a few minutes, but look, here's a classic thing for stock analysts. When you only see the generals make new highs and all the troops don't, that's called a huge divergence and a sign you're gonna see another downturn. So the next wave, if I'm correct, the next wave would have to go lower than the first wave and from near highs in some indexes, not in the small caps and stuff. And that would end up having the stock markets, let's say by the end of 2024, down 50 to 60% instead of the 38 and 28, okay? So that would be the sign, okay, yeah, no, they weren't able to prevent this crisis. The stock markets are reasserting themselves saying, hey, something's rotten in Denmark. That would be the middle wave down, and every major crash in history has had 3 waves down, and the last wave would follow that. But most of the damage should be done in this next wave, and it should happen this year. Otherwise, we really do have a bubble and a non-burst for the first time in history. And I don't think anybody knows what to make of that. Because that is never, ever,
okay.
ever.
So you're seeing a 50 to 60% decline by the end of 2024 from where we are now? Or from?
Well, stocks from the top, and it's different and different. And we'll be down 50 to 60% and still have made one more wave to go after that. But that would be the sign that despite all this stimulus, and because they finally were forced to tighten, that the markets got better. I'm just telling you, I know the markets. The markets don't want this, okay? The markets being forced to take more and more crack and get more out of whack and not rebalance themselves. The markets are great at growing and expanding and great at quickly. That's the secret to free markets. That's why George Gilder is my famous traditional economist. He says, you have to have the freedom to grow, but you have to have the freedom to fail. What we've been preventing since 2008, we're not allowing failure because they're scared failure will cause the whole castle to come down. And the truth is, it will after a bubble. And this record debt in all sectors, government, business, consumer, and financial sectors, all record debts beyond anything. You can't even compare this to the 1929 in the Roaring '20s bubble. Can't even compare this. Way more global, and it is an everything bubble. There's almost nothing that hasn't bubbled.
All right, now you said, though, that you see 2 specific signs that will give you an indication that this next wave of the crash is underway. And I'm not talking about by the end of 2024. You have a nearer term outlook in terms of confirmation. What are those signs?
Okay, Bitcoin is the lead dog, okay? Bitcoin is crypto, and this is a great sentence I got from an expert, Mark Yusko. The digitization of all financial assets and money. If that's not the next big thing, I don't know what is, okay? So Bitcoin is the lead dog in this new emerging industry, which is much like Amazon and the online retailers in the first tech bubble in the late 90s and early 2000s. That was a bubble in all tech stocks and stock, but those Amazon stocks, Amazon went from 6 to 136 in a year and a half and back to 6 in a year and a half, okay? That's a bubble, and that's a burst, and that's extreme. So I want to see Bitcoin starting to fail here. And oh, by the way, stocks are still edging up, but guess what? Look at Bitcoin. It went up to 48. That's right where there was resistance. And it's last I saw it was at 42. If Bitcoin breaks down like below 40, that's a sign that we're probably going into another wave down. and then stocks have to follow. And again, so Bitcoin breaking down sharply below 40 is the first wave. And then the NASDAQ, the lead dog in the stock arena, does have to break that first wave down low, 10,088. That'd be the second sign. If they can punch through that, not just test it and bounce out, punch through that, that means we're going down faster. And that means that a major crash is underway. If we don't see both of those, then it's not really happening.
So Bitcoin, so Harry, just to be clear.
If we just go sideways forever and never see a nice boom again, because we never did what free markets do best, clear the decks from all the bad debts. We have record bad debts and record zombie companies in our economy. That's what you clear out in recessions. The normal course is we have a recession once every decade and we boom for 7 to 8 years, and then we slowly go into recession for 2 to 3 years. That's how an economy actually stays healthy, just like we're awake 18 hours a day,
sure,
and then we sleep for 6 to 8 to rebalance again.
Sure, I mean, and those are patterns that you see in nature.
We're not letting the economy take a nap, okay?
Right, and I get that, and that's the healthy way, and that's the pattern that you see in nature everywhere. But Harry, let me just.
You know how long the average person lasts if they couldn't sleep? 3 days before they turn into a crazy person. 3 to 4 days.
Okay, well, sleep is very important, Harry. Let me just get some clarity here. You're saying, though, that Bitcoin is your signal that the broader crash is underway.
Just because it's the leader of the leading edge segment, which is cryptocurrencies, which is nothing about these stupid coins. It's just that coins are cheap IPOs, okay? So they can start a lot of companies. Most of these companies are going to be worthless and fail, okay? But it is about the restructuring and digitization of the entire financial services and financial asset industry. And I'm the only guy I know that knows in the world how much financial assets in the world. You want to take a guess? $630 trillion, 5 times global GDP at 105 trillion. So that is the next big thing.
So
I was
Bitcoin,
looking at crypto as the next big thing because it was acting like Amazon and the .com. But when that guy gave that definition, then I could see it would have to be the next big thing. If it can totally digitize and make more flexible and efficient the entire financial asset structure. It's the biggest number in the world financially. Biggest, I can't even, GDP is the next at 105 trillion. If Bitcoin can keep going sideways to up, then I wouldn't expect stocks to fall this year. Until I see Bitcoin do that, I'm not going to expect stocks to fall. Own little bubble world, and it is the next big thing, and they know it is, but they think because it's the next big thing, it can't fail and go down. Well, tell me why Amazon went from $136 to $6 in a year and a half when it was the next big thing on the same track. I am tracking the whole Bitcoin and crypto industry with Amazon and the internet industries 22 years before them, and you have 2 of these major innovation cycles in a 45-year innovation cycle technologically. So I've studied that too. So this is what I'd expect something to be doing what the .coms and online retailers, their breakthrough in the late 90s, in the last bubble, in this bubble, and I've determined it is Bitcoin and cryptocurrency, as crazy as it sounds, an invisible coin, you don't get crazier than that doesn't do anything, and like Warren Buffett doesn't produce anything. That's going to end up being the gold standard for a digitized world. That's my forecast. They're not. That's what I figured out. They're acting exactly like Amazon and the .com stock, exactly on a 22-year lag. That's not different. Gold is also, again, this whole timeline is getting stretched because they're able to keep pushing this crash out. The whole thing is don't let Humpty Dumpty fall off the wall because he's going to crack and break. Okay, that's the whole Federal Reserve thing. They pumped up a big bubble. They didn't intend to. They were just trying to save us from the last bubble crash. Now they got this huge bubble and they can't let anything fall apart. Okay, so that's the whole game here. They're keeping this thing together. Gold in the 2008 downturn and crash, which to me, I'm telling my subscribers, okay, that this next downturn is just 2008 recession, Great Recession, times 1.5. 50% greater stock crash, 50% greater unemployment, all of that. It's just what the crisis needs to be to finish off and detox this whole greatest bubble in all of history, okay? So in that scenario, in 2008, gold held up in the early stages of 2008 and only crashed in the second 2 quarters, and then it crashed about 45% briefly, and then went back up again. So gold was not the worst crash back then, but it did crash and went running to mommy when everything else. It was the last thing to crash. And I would see that happening here, that it's going to go up to, 2022, maybe 2,300, not a lot higher here. But if everything else crashes later in the next year or two, what I'm saying to substantial new lows, gold will follow. It proved in 2008 when things got really bad, it was not the safe haven. And what was proven to be the safe haven, but I don't know why I have to argue with Peter Schiff and people about this, the 10 and 30-year Treasury bonds went up 40 to 50% in late 2008 when everything, including gold, finally went down. It was the safe haven, and that's what I want to be sitting in, TLT. Average 20-year Treasury bonds, and I'd rather, most people be better just to buy the 30-year. You're going to get 4.5% interest, and if things go bad, that will be the one thing that will damn near sure go up, because money's got to go somewhere, and that is the safe haven. And gold would be, if we had an inflation, if the government got so desperate that they printed so much money that it just became hyperinflation, like Germany back in 23. But this is not even remotely that. But if they did that, then gold would be the answer, and that's what Peter Schiff and the gold bucks think. That's the last thing. I am not buying gold, but I'd rather hold gold than I would tech stocks here. Circumstances default. Corporate bonds, especially the more risky, can default. It's default risk. A downturn only brings lower inflation or even deflation, and that alone brings down yields in bonds, okay? So bonds normally benefit from a downturn. But bonds that can default, like the corporate bonds can, and especially the high-risk corporate bonds, those will go down and have gone down, did go down in 2008 because of default risk. What will not default, if the U.S. government, for all these years, 14, 15 years now, can print money without abandon to keep the economy from collapsing, they can print money to pay off their bond. They will not default on the interest or the maturity of these bonds, and that's why they're the ultimate safe haven. A lot of corporations, even good corporations, may have to default or miss some payments, and that brings the value of the bonds. When I said about gold went down, you guess what the dollar did in the second half of 2008? U.S. dollar. And we had one of the worst.
It did. Yeah.
We're the best house in a bad. Are we good? Are we in debt? Yes, but Japan's more in debt than us. Most of Europe's more in debt than us. All the other developed countries are, except for Australia. Okay, so the dollar and the U.S. Treasury bonds will be the safe haven. But I want the Treasury bonds because they're locking in low, interest rates for a longer period of time and will benefit more when safe haven interest rates go with deflation, while risky interest rates like corporate bonds look more at the default risk. The Treasury bonds just see the deflation, which is the positive for bonds in a downturn. That's why Treasury bonds are the one and really the only safe haven if we have a 2008 downturn times 1.5, so that it's even worse than that. The Treasury bonds were the only thing that went up at the worst of that crisis. Well, apartment bill, if you got to be in real estate, apartment bill is the only thing that'll hold it. They'll still go down because all of real estate will go down and that sort of stuff. And there'll be some default problems there. People won't be paying their rents and da-da-da-da-da. But if I was going to keep any real estate, I would keep stuff in the multifamily kind of apartment rental sector. And I wouldn't even keep that myself, but that's the one sector I would consider keeping. Everything else in real estate, this real estate does not usually bubble like this. It didn't even in the roaring 20s. But lending has been so free and exaggerated. Real estate will see the biggest downturn in history. Now, first of all, nobody expected in the last downturn, the average house went down 34% at the worst, and it took 6 years to do it, from 2006 to 12. So longer slide, longer to come out, but down 34%. Just to go back to support and just to erase the gains, just in this last final bubble, not the previous bubble, we would have to see the average house go down 50%. That is the biggest thing that's going to hurt the everyday household. The everyday household doesn't own a hell of a lot of stocks, okay? And they're not even in Bitcoin. And if they do, there's probably their kids, and they want the kids to learn a lesson anyway. So I'm most concerned about real estate because Bitcoin will come back and go higher, okay? Stocks will not. I think we're seeing highs we won't see in most stocks, and we're seeing highs in most real estate we will not see in our lifetimes for people like, say, over 40 or 50. I don't think we'll see in the US because we're now going to start slowing like Japan and other developed countries have, that sort of thing. But Bitcoin will come back because it's the next big thing. So I don't want to hold Bitcoin because I actually have a target of 3,250 to 4,100 on Bitcoin, or at least 10 to 11. If it gets there, then I'll start buying, okay? If you look at a stock chart, it goes 1, 2, 3, 4, 5 peak, and then when it crashes, it goes just back to the 4-wave low before the 5 peak. That's all Bitcoin would be doing, to go all the way down to 3,250, just retesting the late 2018 bottom after the last peak from 69,000 crash. The last peak from 20,000 crash down to 3,250. All it's doing is testing the last major low. So if I was looking at a chart and didn't know what it was, and I didn't know it was crypto, and I didn't have any ideology, it can't go this low because of this and the cost of this. And I get these arguments all the time because I'm in crypto land. All the crypto people are moving to Puerto Rico to save taxes. You can have capital gains in the future, okay? If I just saw the chart, it'd be a slam dunk. It's going back to the 4th wave low. That is 3,250. Yeah. Okay. And so what is an orgasm? Now I'm talking the male orgasm, okay? Male orgasm, you get excited, it goes up. It's extreme excitement. It's not just hum-de-dum and things are getting better, yo-de-do. It's excitement, and it gets so intense, it can't last. That's why bubbles have to burst. So that's what the orgasm does. When I lay that Masters and Johnson, independent from a different arena, over any major bubble in history, it fits better than anything else. Now, what I bring up the female orgasm is females tend to have multiple orgasms. I don't even be 2, 3, 4, 5, whatever. But the typical, what Masters Johnson said, the average must be 3 orgasms. Well, you look at the 1987, the 2000, and 2021, 3 bubbles in a row. Well, now you got, on a bigger picture, the female orgasm. So bubbles, I tell people, bubbles are, and I don't mean it's kind of, somewhat, maybe, they are exactly like they are exactly like orgasm. And it's just in a different arena. And if the model, when you put the Masters and Johnson's model, and they're not measuring stocks when they did this model, and it fits so well, it's kind of like, well, maybe, and it makes sense because bubbles are intense. And the thing about bubbles is people always they go up so much, so fast that even the people out of them eventually get drawn. I think Irvin Fisher in 1929 fought that bubble and finally got in at the last minute before it crashed. The bubbles draw everybody in, and then they go down, and then after they crash, people go, how could we miss this? How could we have been so stupid? It was a bubble, damn it.
So to recap,
you know why they don't see it, Michelle? They're too high on the bubble to see it. People high don't make good decisions.
But in your newsletter, I believe you were saying that the current wave crash that we're in more resembles the female orgasm. Is that correct?
No, the succession. I said succession of waves, 87, 2000, 2001. Those are 3 bubbles, each one getting 87. When 87 at that time, we'd never seen that big a surge in a short period of time. And a 40% crash in a couple of weeks, that had never happened before that, not even in the 1929 crash, okay? So that was a sign, if you'd have been awake, and I didn't get that back then, oh my gosh, we're going into a bubble era. The baby boom is so strong, inflation's falling from such high levels, caused by the cost of the baby boomers getting in the workforce. That's why inflation was high in the 70s. It wasn't government deficits. We've had way bigger government deficits with inflation now. So all of that extreme thing caused this kind of orgasmic kind of scenario, and it turns out that this orgasm model from Masters and Johnson is the best corollary I can find to say this is what it looks like. So if something goes up that extreme, and that's what I say, everybody's hoping on a soft landing here. And this is when I'll quit my profession. If we can get through the next 2 years with a soft landing and the markets only go down 20 or 30% and nice and orderly, and then we get inflation down to 0 to 2%, and we don't have any big crash and big failures of companies, then I'll say, you know what? we're in a new economy and I need to retire. Well, again, here's the problem. The Fed already overstimulated when they didn't need to. COVID would have been a perfect excuse to let the economy grow a little slower and work off some of this excess. They already overstimulated and then over-tightened. That tightening, even if they start changing their policy today, that policy is going to take a year and a half to hit. And so a lot of this could still follow through. So they already laid the groundwork for a crash to start to develop that's hard to stop. So that's what I'm looking for. If we can see a crash, and hard to stop means it's got to go below that last low. If we can't break 10,088, then it's not that hard to stop, okay? So I'm looking for that this wave already looks like it may be turning over to me. Bitcoin is leading it. That's my first sign. Bitcoin should lead this if it happens. It is so far. It's already dropped from 48 to 42 in a short period of time. It has to keep going, okay? If that happens and if stocks start dropping sharply and then it breaks that last low in stocks in the first crash, then it's going to be hard to stop because people are going to finally say, well, we thought the Fed was in control, but they're not. And the truth is, there's not a Fed official or chairman in all of history that's ever had sex or run a business, okay? Not a one. So these guys just know how to manipulate and print money, which is the thing. They don't understand the economy from my point of view. Well, you know, a challenging economy kills the incumbent. So if we even have a continued very slow economy, 2024, Biden is dead. Biden's also not a dynamo, okay? I mean, he's a nice guy. I like him, but he's not a dynamo. Trump is a dynamo, but I hate to say it. I mean, he acts like a crazy man. You know, do I want him in charge? I personally feel like it's an embarrassment to the world if he's president for a second time. That's just my personal point of view. I don't disagree with him on half or more of his policies. I just think, you know, he's not the right guy for this. But what I would tell any politician, if I was advising Biden, I would say, step out gracefully while you can. You're a dead man. If this economy is flat to down this year, if I'm even half right, you are dead. And people blame the president in office for what's occurring now, you know, in the current time, and they usually have very little to do with it. These things are already set in motion. This 2008 crash, I was predicting back in the early 1980s, for crying out loud, okay? So I wouldn't want to be the politician in office when that happens, because people will blame you whether or not. Biden's not the cause of this, but if the economy's weak this year, there's not a chance of him getting reelected. And I'm hoping somebody other than Trump gets it, because otherwise it's going to be hard for him to get more than 40% of the vote because he's so kind of controversial. But if the economy goes down, it's going to definitely embolden. It's definitely going to be good for the attacker, or especially Donald Trump. So that's Donald should be praying for this economy to go. In a weak economy, just the fact that the economy's been strong for so many years increases the chance that it'll at least be weak this year, it's because you can only do so well. So in a weak economy, the Democrats' only chance is to not have Biden and have a new dynamic candidate. Okay, that's their only chance. I think in the type of steeper downturn I see is more likely that the incumbent, the attacker, the new candidate, whether it be Trump or another Republican like Nikki Haley, are going to have the advantage no matter who they put in there.
Really? So even if the Democrats...
economy, they're going to be blamed, but Biden is going to be blamed 100%. So he has no chance if the economy's either weak or down.
And have no fear, Lael Brainerd is here. She's a modern monetary theorist who was at the Fed, who worked with MIT in development of the new central bank digital currency that Biden signed into executive order that ushered in FedNow, which came out a few months ago, which is Venmo or Zelle on steroids backed by the Fed. She's a modern monetary theorist. So if you bring everyone down to their knees because everything collapses, and it was those sons of bitches who did it to us, they did it to us, how could they? And remember, where's the debt go? Who do we owe all the debt to? Medicare, Medicaid, Social Security, and government military pensions, that $100+ trillion is owed to us. Who's buying all the bonds that the Chinese are no longer buying, that the Japanese are selling? Saudis are selling. Russia has already sold. All of these countries dumping bonds. Who's buying them all? Well, yeah, that's us. The hedge funds and the investors chasing yield. So if indeed there really was a plan to allow this to happen, the majority of the debt that we owe is to ourselves. A whole hell of a lot easier to issue, as a modern monetary theorist, a central bank digital currency to us and make us whole by signing on the dotted line and taking that CBDC, which many of the people watching this show would say, I ain't ever taken that, until your bank blows up, your 401k blows up, everything blows up, and the federal government comes on at 6 o'clock at night and says, listen, we understand what's happened. We're very sorry. We're going to rein things in this country and be more protectionist of our own interests, and we're going to issue a new central bank digital currency. If you take it, you'll be made whole. Now, again, this is me trying to put all of these facts together and come up with a logical, Occam's razor, call it, a logical outcome. But when the majority of the debt that we owe is to ourselves, it makes this whole situation a whole lot easier. And rather than pulling Bernanke and Janet Yellen and all of the former Fed and current Fed and Treasury chairs out and doing what happened to Marie Antoinette out in the town square, you can blame a villain. And that villain did this to us, inciting a rallying cry. So am I trying to connect the dots? Sure I am. But look at all of the facts that are coming or pointing to something happening. And I think it happens long before 2031, when we have to borrow every single penny of discretionary spending to do anything, including funding our military, which is supposedly the biggest in the world, and we're yet, blowing off bombs like they're gumballs. It's a situation that I don't think can last under the current path that we are on right now, and something's going to break, whether it emanates from the BRICS or from within. And whether it's intended or not, I think the day of reckoning is coming. In 1974, whereby for the protection of the Saudi kingdom and by extension OPEC, the promise was to value oil globally, price oil globally in dollars, and to recycle those profits into U.S. treasuries. And for that protection, then, the dollar would be the king. It would be every country on the planet would be required to purchase dollars or to stockpile dollars in order to purchase oil. And it has created a synthetic demand, in essence, for the past 50 years, and arguably has allowed us to live perhaps even above our due standard of living. And I think people need to understand that the fact that the dollar has been for 50 years the standard by which every country on the planet buys oil is an exorbitant privilege, and one that I think should be nurtured and clung to and not really be pushed away the way that this administration has really done a very good job at doing. I mentioned to you offline, I'm very fond of a term called logarithmic decay, which speaks to little by little by little by little by little, then all at once. It's almost like going over a waterfall where you see the pitch of the water starting to get steeper and steeper and steeper until you fall off the cliff. And, so I'm not saying that this is going to happen today or tomorrow. It could. But what I am saying is that we are witnessing little by little by little by little by little the chipping away at the dollar hegemony. I mean, let's look at the fact that, for example, every single OPEC country, all of them, are on the Chinese Belt Road and Rail Initiative, the largest infrastructure project in human history. Let's look at the fact that Saudi Arabia indeed did just join BRICS and was formally admitted 2 days ago. Let's look at the fact that Saudi Arabia did indeed join the Shanghai Cooperation Organization, which is the largest regional financial and military organization on the planet. And they joined the BRICS New Development Bank. You can see where they're going, but what became very provocative to me is what we are witnessing here right now. And that is, they told the folks at the World Bank meeting earlier this year that, yeah, you know what, we are interested in listening to other countries who want to buy oil in other currencies. And this is a very, very big deal. And when you look at the coalition of countries, so you mentioned the size of the BRICS in and of themselves right now, it's growing in significance. In fact, this year alone, the BRICS countries are responsible for more GDP globally than are the G7. Just a little bit, but it's beginning and growing, as is their their union. But when you put together these groups, the Belt Road Initiative, which as in and of itself is responsible for close to 75% of human population, 50% of global GDP, along with the Shanghai Cooperation Organization and the Eurasian Economic Union, who the president of Belarus says needs to all join BRIC because they're largely the same countries with the same goals and ambitions. And you put that together with BRIC, you're talking the majority of human population, north of 85% of human population, the majority of global GDP, the two of the three largest nuclear arsenals on the planet, and the stranglehold on the majority of the world's natural resources, energy in particular. So yeah, this is a big deal, Michelle, and it's not one to take lightly as far as I'm concerned. I am a patriot. I am someone who represents the least likely character to achieve what I have. I came from nothing, literally 33 years ago, and my father and I started this company in a closet-sized office in Minneapolis. From nothing, but a loan from a friend who, my dad's middle name is Miles, his best friend who lent us some money is Franklin. This country has presented me more opportunities than I could have ever dreamed of. But I have to tell you that I think indeed we are heading down a very, very dangerous path. And when I see things, always have, I think, long before they happen, and I don't think you have to be a rocket scientist to put all of this together and see it. Now, what is the fuse that ignites it? What is the springboard or the impetus that makes that moment where countries forsake the dollar? I don't know what it is or when it is, but I will tell you, I honestly do believe that this is the ultimate goal. And when you put it into context with an administration whose, as we've talked about before, main economic advisor, his whole thesis, Jared Bernstein, is to lose the reserve status and look at weaponizing the dollar. Look, if the reserve status was so important to us, then why the hell would we tell Saudi Arabia and the rest of the world we're going green when it is the linchpin to the dollar hegemony, the petrodollar? But we're going green, so it's all right, you guys. We're going a different direction. And the countries that they are uniting with, which represent the majority of human population, are the ones that have all of the world's oil and natural gas and rare earth metals and all of the things that you need to build an advanced society. So it just doesn't make sense.
Right, and we've spoken about Jared Bernstein before. We'll cover that again. But before we do that, again, you make very, very valid points. Just as a counter argument, a lot of this is dependent on the leaders.
And when you look at the countries that have been admitted, there, as you mentioned, there's actually 20 countries that have formally applied, and up to another 20 that have informally applied. Every single one of them has one thing in common for sure, and that is they are very, very rich in natural resources, in particular energy, or the rare earth metals needed to make batteries, or precious metals, or all of the above. And also very, very, very tied into strategic shipping lanes, like the Red Sea, like the Straits of Hormuz. And if these countries that are on the list actually do become BRICS members, they will control the Straits of Hormuz and the Red Sea, and they will control very strategic shipping lanes. And they have the new BRICS Naval Alliance, where a lot of these countries are banding together to patrol the Indian Ocean and perhaps ultimately the Red Sea, where, you have the U.S. Navy, who's been doing all of that heavy lifting for a while. But ironically, whether you're talking the Belt Road Initiative or you're talking the BRICS, I think the president of Iran said it best. He says the most important problem is represented by three issues. The first is energy production. Okay, they got that covered. The second is energy transfer. Okay, got that covered. That's the shipping lanes and whatnot. And the third is energy consumption. And when you talk about these three issues, he says BRICS has solved that. And they are indeed, this is their very methodical plan, where they're doing it little by little by little by little by little. Look, Jim Rickards is a man I respect a lot, Michelle, and he made the statement this last summer that in the meeting in Johannesburg that he would expect two things to happen, both of which I agree with, mind you. One, the Shanghai Cooperation Organization and the Eurasian Economic Union would join BRICS. Well, the president of Belarus is calling for a summit to do just that. Didn't happen in August. He got a little pushback. That's okay. The second thing he talked about was that they would issue a common settlement currency. Now, the difference between a settlement currency and a reserve currency is you can trade in something, but when you have excess, what do you do with it? So it's always gone into U.S. Treasuries, the most stable liquid market in the world, although that hasn't worked out so well for them over the last year or two. But the bottom line is simply this. I think that there will indeed, because that didn't come to fruition, so the finance ministers were tasked with going back to the drawing board and coming back to the meeting in Russia in October and presenting their findings. It will happen. After all, gold was reclassified the only other tier 1 asset in the world by the BIS in 2019. And lo and behold, is it a coincidence that the world's central banks, largely these countries that we're talking about, have bought more gold over the last 2 years than any time in central bank history? There will be a moment, just like the Russian finance ministers promised us, where they issue a common settlement currency. And I think it will be pegged to commodities using blockchain technology to show the veracity and the immutability. The head of the IMF, in the report they wrote right around the time that you and I had our interview in Vancouver, gold a barbarous relic, or gold an international reserve currency, barbarous relic no more, something to that extent. And then she came out a few months ago and said any central bank digital currency not pegged to something is fiat. Well, what would it be pegged to? And when you talk about could this happen in October in Russia? Sure, it could, absolutely. And I think the way that they would do it, because see, President de Gaulle, who drained a good portion of the gold from our treasury in 1970, 1971, proved that convertible currencies convert. So what blockchain does is allow the immutability and the veracity of which each country pegs to be there without having it convertible. In other words, maybe you peg 10% or 20% of each currency unit to gold held on the blockchain and audited by independent international auditors. You can do that if you are open and transparent and do it the right way. You still have the ability to transact monetary policy because it's not a one-to-one, but a small percentage, but just enough to tether it, because given the choice, politicians will do what all politicians have done forever. Even going back to Roman times when they clipped the coins, that's why there are ridges on the side of gold coins, because they would clip it and make it just a little bit smaller. You do that enough, you have enough to make more coins. Well, going back to the beginning of money, politicians will choose inflation over austerity. So yeah, I think this is how you give it credibility in a system that I believe has already lost a good amount of credibility, in fact, and is losing it rapidly across the globe. So yes, the marriage of blockchain and the marriage of commodities together inspires confidence. And that's why when people say, who's going to trust? Well, you don't have to. If you do it the right way and have it audited, have it transparent, and everyone pledges the same thing to the distributed ledger, to the blockchain, you got a real fighting chance. And you asked me when we were in Vancouver, well, what could the West do? And I brought up Kristalina Georgieva's report. And at that point, she hadn't made the comment. But now she has. And she said a CBDC not pegged to something is fiat. Well, how does the West maybe stop this? How does the West maybe pull up from this nosedive? Do that. Get some legitimacy and credibility back into this system. One that is lacking it and is lacking trust. And indeed, you talk cryptocurrency again. It's about confidence. If you have no confidence in whatever it may be, then you're waiting for a rug pull. You're waiting for something to collapse. And I think no one will drink the Kool-Aid ever again the next time around, unless it is pegged to something with transparency. Zoltan Pozsar calls this Bretton Woods 3, a system that will be dominated by commodities and transparency. This is the way to do it without having it convertible immediately by anyone who walks into a bank, like they could do back here when this $20 gold certificate was the same thing as a $20 coin. And it's funny because now it says in God we trust, but back then, before 33, it says payable to the bearer on demand in gold coin. So it used to be one-to-one conversion. I don't think you'll see that again. But what gold will do when it marries with blockchain is to show exactly what every country has in the union, pegged to the system, giving them equal say at the table, and using blockchain technology to show the immutability of it. I think it is what they're thinking, but I guess only time will tell now, Michelle.